People will say, oh, why do insurance companies make so much money? Because they don't really pay taxes, right? All these incentives out there for certain industries, but they change over time. The 90s and early 2000s, the incentive was in the old school energy, right? Oil and gas. But now they're changing. Now they're changing into green energy.
As long as you follow the government's lead on those things, whether you agree with it or not, there's going to be incentivizing items as it relates to investment.
All right, welcome to this episode of Tech Careers and Money Talk. I'm your host, Christopher Nelson. I've been in the tech industry for 20 plus years. And after climbing my way to the C-suite, working for 3 companies that have gone through IPO, I'm now financially independent and sharing everything with you so you can do the same. I'm super excited today to introduce Greg O'Brien and John Malone of Go CPA. They are a premier certified tax planning organization based out of Boston. Yes, I didn't write this. Greg O'Brien, John Malone from Boston. Yeah, it's good. But the fascinating thing about their company is they focus on, small businesses, high net worth individuals to be able to combine premier tax planning services as well as technology to be able to streamline and make this effortless. And one of the things that I think is amazing about their group is they talk about they want to make tax planning and tax efficiency really part of your wealth strategy, which you don't hear a lot. So I'm excited to introduce today Greg O'Brien, John Malone.
Thanks for having us, Christopher. Excited to be here.
Yeah, Christopher, it's super exciting to be here and love kind of the movement you've started. So hopefully we can really contribute to your audience.
Well, great. And this is where I'm excited to introduce what you do, because many people do not understand the difference between a tax preparer and a certified tax planner. And when I'm out with friends and I say, you need to understand what a certified tax planner is because it's going to change your life and your approach to taxes, they ask me, what's the difference? And I say, well, a tax preparer is very similar to the crime scene investigator that comes and draws the chalk outline around the body. Like, the crime has been committed. You can't go back. Really, you owe what you owe. Where I think of a certified tax planner as like Tom Cruise in Minority Report, where you're looking into the future and you're saying, okay, what do we need to do to try and avoid something, to try and actually get the government to work with us and make more money? And so I really want to try and understand, first and foremost, like, what's the journey from, I'm going to college in Boston to now I'm a certified tax planner.
I love it. I'll start with that one, because the beginning part of this story is kind of the same for us. So John and myself, Greg, we went to college together at a smaller college called Bentley University outside of Boston. That's where we met. We played football together. We were co-captains as well our senior year. So that's kind of where our leadership journey started together. And then, it's mostly a business school. So I was an accounting major there. For some reason, I stayed and got my master's in taxation, which is like a weird master's degree to have, but it was fascinating at the time. And so worked there, went there for 5 years to get my master's. And then I worked at a traditional firm. So you think of your regional firm you might have in wherever you live, the 75 person firm. It was very, very heavy tax season. We're talking 70 hours, 6 days a week, just a mill of preparation, right? And it was very interesting to me at the time. I got to see a lot of people's tax returns, right? From, uber wealthy to normal people, and just seeing how people made money, which was very, very interesting to me. So I kind of got my entrepreneurial mind churning a lot. And I was on the account of somebody that owns a pretty famous restaurant chain across the US. And this guy was filing in 50 states, international. I'm like, wow, this is amazing. Like, it was very cool to be a part of that. But I started getting a dive into like what his team, he had a full-time family office, what his team was suggesting and the different maneuvers he was making, right? Especially around real estate. So that kind of got my mind churning at a younger age. Well, from there, I kind of got burnt out of that, and I went into real estate. So I worked for both a privately held real estate developer here in Massachusetts and also a publicly traded REIT, Federal Realty, which I love both those companies. Worked on the financial accounting tax side of both those companies for both 4 or 5 years. That really got my real estate journey started in my head, because I just was like, wow, this is amazing what people can do with real estate. So, did that, but it was also a corporate grind, right? So I I was in the corporate world, and I saw my path, right, to kind of going the financial CFO route, and it was a very well defined ladder, and the ladder was long, and there were many rungs ahead of me. So in 2016 ish, I decided, hey, I'm going to be an entrepreneur. I don't know how I'm going to do it. And I just really started studying self education, Tony Robbins podcast, you name it. I was listening to it, just figuring out how I was going to get the courage to quit. John was one of my mentors as well. You know, he's my best friend, but he's also a mentor. And I said, hey, I'm going to do this. And they were like, just go for it. So I am an accountant by trade. So I had to have everything mapped out, planned out, budgeted out, everything, 5-year forecast, everything was ready. And then in 2018, I woke up one day and I said, I quit. I just quit. And I started the journey. So starting off, I didn't know anything else but the tax preparation game, right? Because that's where I came from. So I said, hey, I need to just be a tax preparer. I need to acquire thousands and thousands and thousands of clients to make money. I was very fortunate within probably 3 or 4 months of starting. I was in a networking group and someone said, hey, you should check out the American Institute of Certified Tax Planners. They offer a different designation. It's really cool. You can charge a lot of money for these things. But I figured out how much it costs to get licensed, and I'm like, is it worth it? So again, I vetted it.
Not
Yeah,
in the
yep, it
budget.
was not in the budget. So I flew out to San Diego in 2018 or early 2019 January for like a week long intensive, and then had a big course after it and some testing. But my eyes were open, right? I was like, wow, these are all the strategies that
Wow.
the 1% uber wealthy are using. And now that we can bring them down to a normal client base, right? And we can also show them, hey, you can really save money and increase your ROI in whatever you're doing if you're active throughout the year in your tax planning journey. So we're talking
Right.
3 months into the business, I completely pivoted the model and said, we need to do this differently, right? We don't need a lot of clients. We need fewer clients that we're very, very in depth with that want to be educated and want to learn
Yeah.
this. So that was, early 2019. Now, here we are 4 years later. Things have grown a lot, and I'll let kind of John jump in here as well. But we've grown to a team of about 25 now, headquartered in Boston. We are fully virtual. Just John and I. John and I are in Boston. The rest of the team is across the U.S. But John's background a little different than mine, and we kind of converged back in 2021, and I'll kind of let him pick up from there.
Well, yeah, and I'll help tie it in and lead into John, is because you got the CPA, you got the accounting side. John's a lawyer.
I am, yeah. So I guess I'll pick up. We obviously met each other at Bentley. That's kind of where our journey started. And then I went to law school, and my kind of idea was like, I'm going to go to law school. I'm going to become this, bigwig lawyer, kind of climb the ladder and do that thing. I think that's kind of where my mindset was post college. And I got into litigation and worked at small firms, and then one of my good friends started his own firm, who I'm very close with, and then I jumped on with him, and it kind of built that firm up and helped him build that firm up, and that kind of really spurred like the entrepreneurial side of what I wanted to do. And I think just as I got into that, I just realized my passions really weren't for what you would say is like your prototypical lawyer, right? That's looking to just kind of litigate, be in the courtroom. While I admire that profession significantly, and there's parts of it that I do really love. I just realized that my passion was just for business and was for helping businesses grow. And I didn't really know how to do that, but I just knew that I was kind of addicted to business, and how it could evolve. So I jumped out on my own, and I started doing kind of corporate work, helping businesses off the ground, helping startups, and then started doing a lot of business with Greg and with Go CPA, or Greg O'Brien CPA PC at the time, which is how it initially started. And Greg opened my eyes to tax strategy, and how he's applying it to businesses, the type of clients that he's working with. And it was amazing to me because I was like, this is something that is really the biggest expense and the biggest investment that people are making is the amount of taxes that they're paying that could be used for investment, right? Or could be used to be reinvested in their business or reinvested in themselves. So I just saw this as like tremendous value add and something, an angle that I had not thought of or really contemplated as it relates to taxes. So, in the tax code, and it's a book of laws, right? So it's very much akin to what the analysis and how my brain works. So we joined forces, and started really honing in on this model of how can we drive and optimize our business clients, right? From a tax perspective, I think our focus has always been on generating a return on their investment in us, right? We want to be viewed as any other investment decision, and really having them understand the opportunities that are before them that are not really like out there. They're not, people don't know. I mean, there's so much information. The tax code is changing like week by week, right? So being at the cutting edge of that, and delivering services that can really get them on the right track, but then like be their execution partner throughout has really been like what drives us.
And so, do you find that Greg having the accounting background, you John having the legal background, that you create this double threat up, or this double opportunity where you see lenses from both sides and you understand then how to make these strategies work?
I totally do. I mean, I think it's something that we talk about a lot, right? Where there's, I think you kind of take for granted that like the tax accounting CPA industry. I think there's so much
Mm.
overlap, but there are nuances on both ends. That's like, oh, this is the lawyer's job, this is the CPA's job, and there's this like Chinese wall. So while there's like regulations that we have to tiptoe and be careful about and make sure that we're walking the line appropriately there, I think that there's just so much from an analysis perspective that we can kind of bring together, which makes a very like holistic approach to what we do, which I think is very valuable.
Mm. Well, yeah, and I think it's important. I think that especially as this for technology employees, as your net worth climbs and there's more at risk, and you want to execute more advanced tax strategies because you don't want to pay as much, having that level of comfort that I'm getting a lens through a CPA perspective. Okay, this is financially how it can be advantageous for me, and then legally, yes, it meets the laws. I think that having that service can create a great level of
Well, Christopher,
comfort.
I'll just jump in there. One thing I always tell people is, we've seen so many successful entrepreneurs, people that have sold, 9-figure companies in our client base, and oftentimes we're learning from them, right? We're saying, oh boy, like this is very interesting. This person had this company. This is how they scaled. This is what they did. This is how they then took their net worth after that and protected it, right? So we're constant learners as well. We don't have all the answers. We always look for our clients as well to say, hey, this is very interesting. They've been there, done that. They've sold 10 companies, or they've cashed out of these 4 or 5 investments. What did they do next, right? And that just kind of accumulates in our brain, our little knowledge base in our brain of what's out there. And we're always learning new stuff. And John mentioned the tax code is a book of laws. The tax code is approximately 77,000 pages long if you were to print it out. Nobody knows everything. If you meet someone that says they know everything about it, they're not telling the truth. We don't know everything about it. We just focus on the areas we know drives value for the particular people we work with.
That's great. I do want to take a moment and double click into, again, this your awakening of saying, it sounds like you are following the path of most people. I'm going to prepare taxes. Then you said, wait a second, there's this tax planning institute. Walk us through a little bit of, what was sort of that inciting incident that said, I need to go down this path. This is different. This can provide better value to clients and also change
I
your
think I was just
business.
fascinated by the amount of strategies that were out there that I had never heard of. Right. And again, I spent 3 years in the actual kind of grind of public accounting, thousands of tax returns. Maybe like the partners knew about these things back then, but we didn't learn them as staff. And then all of the people I had kind of networked with when I was starting a firm in 2018, no one mentioned anything about any type of business model other than just preparing tax returns. Right. So it was very fascinating to me that as what was out there that is possible to implement. But what I also learned was The reason a lot of people weren't doing it is because it's a lot of work. There's a lot of work to learn it. There's a lot of work to properly educate the client and help them implement it. So we figured out very early on, okay, well, this is not something you can really have 10,000 clients, right? It doesn't work like that. You need to have the right type of client that has the right sophistication and the right issues, right, that you can help them through. And as long as they are buying into that, hey, I do want to reduce my generational taxes, we can do it. And it just really just changed my mindset right around to say, like you mentioned at the beginning, Christopher, on the analogy there, I always tell people that it's a new client. If they come in right now and it's April, I say, hey, we're going to start planning for 2023, right? The past is the past. What happened in 2022 is kind of spilt milk, honestly. You can't wait. The biggest misconception out there is I'm going to do tax planning in December, right? Too late. You got to do it throughout the year, and it's systematized, right? So you got to get stuff in motion throughout the year. So it just completely pivoted the business, in the iterations we've been through over the past 4.5 years. But I've always now encouraged younger CPAs getting into the business, right? Of just, hey, not that you have to do this, but I would take a look at this, because I think this is kind of where the world is moving. More people are interested in this type of stuff. More people are coming into wealth. They have issues, right, dealing with, and the tax code's ever changing. But we always say, with change, there is opportunity.
That's great. What I was going to ask is, do you know how many tax preparers versus tax planners there are out there in the United States
There's
today?
approximately licensed about a 500,000 CPAs. Now, the thing with the CPA designation, right, is it's like kind of saying I'm a doctor, in that there are CPAs that can't prepare their own tax return on TurboTax, because a CPA could mean you're a governmental auditor. It could mean you're an assurance person at PwC. It's a very wide ranging designation. You do have to pass a tax part of the CPA exam, but you forget that stuff pretty quickly. So um, the actual certified tax planner designation that John and I hold, there's about 850. So it's pretty niche. And again, the institute that licenses is called the American Institute of Certified Tax Planners. They're a nonprofit, right? They have no skin in the game other than just to kind of spread their education. The founder, her name is Dominique Molina, very, very smart person. And then she's some very, very smart tax people on her team that have worked at the IRS, that are lawyers, CPAs, right? All these different backgrounds, and they're just on the cutting edge of everything that kind of comes out that we're able to take advantage of.
Excellent. Well, so thanks for the origin story. I think we've covered the origin story. We understand, certified tax planner versus tax preparer. We're going to take a quick pause. And then when we come back, we're going to talk about what are some strategies for high net worth individuals and that they can think about to reduce their tax burden today. We're also going to have an exciting update and announcement around Go CPA. So hang in there. Okay, welcome back. Here we are. Greg O'Brien, John Malone from Boston. Yes, I didn't write that. Let's talk right now. Let's get back into it. Technology employees. The ones who I know, many of them have a lot of holdings in stocks, single stocks. They also have maybe some venture investment, but that's their exposure. And the complaint that I heard, and it is complaining all the time, is this is the time of year, right, in April, where everyone is just crying, going, why are my tax bills so high? Why we have you on the phone, and again, I'm glad that we have, Greg the strategist, we got John the lawyer. This is not advice. We're just talking about some strategies here. Why don't you share with people today, like when you're thinking about this type of scenario, what are strategies that are available today for people to lower their tax bill?
Let me just start off with the first thing, Christopher. I mean, we see, and we've seen a lot of people that, especially in the tech world, they have RSUs or they have different kind of bonus compensation plans. There's often a surprise, right, come April, because they have a large balance due, right? So the tax that you owe in, say, April, right, that is just a true up of what happened. Now, people will sometimes say, I don't understand, because Google, whoever I work for, they're withholding taxes. The issue is, and this is kind of a epidemic among tech employees, is that when they receive RSUs or they receive these supplemental wages, commissions, bonuses, The companies take a position, which they legally can do under the tax code, to withhold at what's called a supplemental rate. So if you're under $1 million, they're going to withhold at 22%. If you're over $1 million, it's going to be 37%. Let's say, for example, your actual tax rate is 32%, but they withhold at 22% on $100,000. That is a large delta right there, right? You psychologically probably don't see that when the bonus comes in December. You're all excited. I got all this money in my bank account. You may not reconcile that they actually under withheld by 10 to 12%, and you don't figure that out until April. So that's the first thing. We always do recommend people check with their HR to make sure that, hey, my CPA said my effective rate is 32.5%. I want to increase my withholdings here so I don't get slammed come April, right? That's not saving you money. That's just helping you avoid the surprise. Now, as far as the saving strategy go, right? So let's just have to go through a couple basic concepts first. W-2 income is what's considered active income, right? It's ordinary income and subject to both income tax, but also FICA and Medicare tax, right? So in your W-2, you're going to have Medicare tax, Social Security tax up to the wage base, taken out of every paycheck, plus whatever you choose to withhold for income tax. That is the most difficult income to offset in the tax code, right? For a reason. The W-2 employees pay the most taxes in the country for the most part. It's not easy to offset those. You need what's called a non-passive loss to offset those. So the typical person that's just investing, say, in a syndication, that loss may not offset that W-2. We're going to show you how to do that in a minute, but that's just kind of the baseline, right? There's active income, and then there's also this concept called passive income. There's also, confusing here, what's called portfolio income. Portfolio income is what you talk about with stocks, dividends, capital gains, interest on banks. Don't confuse portfolio income with passive income. Passive income might be a syndication, right? Limited partner interest in a business, right? So there's all these different technical terms here that can be overwhelming to people. So with tech employees especially, right, we see people oftentimes say, hey, and this is the same that goes for other professions like doctors, for example. They have very, very high W-2 income and they feel stuck. Well, the first thing, right, I think if you are doing Chris, you mentioned venture investing, right? So if you have the cash flow and you're investing in, hey, I get these startup deals that I'm investing in, I'm taking the swing at this AI company or this cool tech company, you should be very educated on the long-term benefits of that. There's something out there called Section 1202. We'll call it 1202 stock or QSBS stock. Some people in Silicon Valley may have heard of this, but if you're investing even 50K, say, into a startup, you should always ask that startup, are you qualified for 1202 stock? What that means is that if that company hits, you could potentially have a $10 million capital gain exclusion on your gain. So for example, if your 50K turned into 9.2 million, you literally pay zero taxes on that. It's one of the best tax breaks that exists. They've tried to reverse it several times, but the powers that be and lobbyists have kept it around. So some people think that, oh, I have to start the startup to get that benefit. Not true. There are rules to follow, but if you properly invest into a C Corp startup that's under $50 million, your gain could be 100% tax free. There's also ways to multiply that benefit, right? We've had people that have gotten $40, $50 million tax free. So that's number one, right? That's not going to save you in the short term, but you could have a huge windfall in the long term.
Yeah, and I'll just jump into Greg and Christopher. I mean, that is probably the most powerful tax code section as it relates to the tech startup world, right? I mean, 1202 QSBS stock is kind of the gold standard for tax strategy, right? There's nothing else that you're going to get a $10 million exclusion per shareholder.
I know that number is just, and I've heard about that before. And the one thing I also want to tease out, and I also want to go back to what Greg, you were talking about, RSUs, tech employees, all of this. What is clear to me is that the advantage is when you understand what you're trying to do up front, you get educated on all the pieces, and you understand how it works together. Because I know plenty of people that have, in this secondary use case, that have invested in venture that I don't believe have asked that question. I don't think that they're thinking about wait, is this an LLC? Is this a C Corp? Can you offer this? I'm going to do 250, 500K. Like this would be worth my investment for you to make that change. Right.
Totally, because I think you need to, when you're making an investment, right, you need to look at the after-tax returns. Obviously, venture investing is
Mm,
inherently more risky, but the returns are greater. And if you can also say, hey, I'm not going to pay that 23.8% capital gains on top of it, that's pretty nice, right? So it can also be a
yeah.
negotiation tactic we've seen for people that are kind of being, early founders of or co-founders of startups. So, but John, I'll let you continue there.
Yeah, I'll say that. I mean, Christopher, it's a great point. I think the our savviest clients, and whether they're investors, founders, whatever, like they are in this world, they are ensuring that their investment or that their company that they're starting is 1202 eligible, right? Like that is like first box to check, has to be done, and it goes to your point of
Right.
just knowing the outcome, and planning for that right before, because once once you do something to jeopardize 1202, you can taint the pool for everybody, right? So like that's something that there needs to be clear
Right.
guidelines, and there's probably going to be some unhappy people if you do that, right? Um, so
Sure.
that that's a,
Yeah.
that's a kind of
If
a
you
planning
unintentionally do
technique
that.
where it's we're talking about a couple of at the high level they look like pretty simple things, but there's layers to them, and it's
Right.
more of just ensuring that you're abiding by those rules throughout the life of the company through exit.
Absolutely. So
Absolutely.
the second kind of topic to hit on here around the W-2 world with tax strategy, we're going to go into real estate, right? So real estate, again, it is one of the more confusing parts of the tax code because the government put a lot of barriers in place back in the 1980s. A lot of high net worth people were taking advantage of the tax code back then, so they changed the laws to make it more difficult. So generally speaking, a real estate investment is considered passive. Like we went through passive versus active before. Most people, it's passive. The burden of proof, unlike the court of law, is actually on the taxpayer to prove that you're not passive, right? So the first way to do that is becoming what's called a real estate professional. That does not mean just getting my brokerage license, right? It means that I am actually in the trader business of real estate full time. Now, here's the loophole for tech employees. A lot of people, right, may have a spouse that does not work a full-time job. If that's the case, you can absolutely structure your lifestyle and your real estate investment portfolio for your spouse to qualify as a real estate professional. From a tax perspective, you're a one joint individual, right? You file together, you're one unit. So if I'm just a single person trying to get into this and I have a W-2 job, you can't become a real estate professional, right? Tax court overturns that all the time. But if you're married and your spouse does not have full-time employment, yes, you can figure that out. There's ways to do it. We've done it with people that spouse becomes a real estate professional. Now, okay, they'll say, why didn't they be a real estate professional? Well, within the tax code, this is where the huge advantages come out. Everything you do in real estate, right? You're gonna hear the word depreciation. You're gonna have ability to write off your investments, the cost base of your investments through the tax code, right? The U.S. is one of the only countries in the world that allows investors to depreciate or write off used real estate, right? For example, I could go buy a building here in Boston that was built in 1726 and I get to depreciate it, even though someone else has depreciated it 100 times already. So it's a very unique tax code, right? So within a real estate professional setting, if your losses we create losses through what's called cost segregation and accelerating these write-offs, if your losses exceed your income, you go negative per se, you can take that loss from your real estate and you can directly offset it against your W-2 income if you're a real estate professional. Now, my asterisk here is that, again, it is very difficult to do this if you are single and have a W-2 job. But if you're married and have that situation, it absolutely is possible. So that's situation one, right? And there's all sorts of rules I'm not going to bore you with, but it's possible, right? Now, I've actually seen more in the medical profession, actually, people that have decided that one of the spouses was better off staying at home with children, raising the family, and getting into real estate than having a part-time job because the overall tax benefits, the overall ROI, and all of the money flowing in was stronger doing that, right? So people do that. The second one here, right, and this is the kind of cutting edge, newer one that I will bet you 4 out of 5 CPAs will immediately say you can't do that because that's the mentality that people have. It is short-term rentals. So a short-term rental, by definition in the tax code, is what's called a transient rental. Now, I think we have to understand the tax code doesn't get updated every year, right? The latest and greatest version was largely written in 1986, a long time ago. They've updated it through different tax changes, right? TCJA, and back in 2017, the Trump tax laws, that was a big update, but it's not a complete rewrite. So they use the term transient rental. Airbnb was not around in 1986, but the concept of someone coming and staying in your house or a property you own for a few days and as a bed and breakfast, it existed, right? So there's very nuanced rules of short-term rentals. What some very smart people figured out about a year and a half ago, and I was not the person to figure this out, is that if you navigate through section 469 of the tax code appropriately, there is a sweet spot where you can have a short-term rental like an Airbnb or VRBO where you do just enough activity that you can create a non-passive rental activity, right? So you become non-passive, and what does that do? As we just explained, if you're non-passive, you can create losses. Non-passive losses can offset W-2 income up to $540,000. So I'll just kind of give the mathematical example here. I buy an Airbnb property for $1 million. I have some creative financing. I put 10% down, right? So I'm out of pocket $100,000. I talk to my smart tax players and they say, hey, you need to make sure this is rented for an average of 7 days or less. I need to make sure that I spend 100 hours on this property and more than anyone else. I also want to make sure I don't operate this like a bed and breakfast. I'm not providing daily linen, daily food services, right? I'm checking some boxes here, but those aren't extremely high barriers to do. That $1 million Airbnb I buy in October, right? So I'm out of pocket 100K for my down payment. I then figure out, okay, I'm going to do what's called a cost segregation study, which is going to look at all of the components of this home from the HVAC, the windows, the lights, the doors, the cabinets, the floors, everything. And I'm going to assign new tax lives to these pieces. Generally speaking, right? Stay with me here. Generally speaking, about 25 to 35% of the value of the building, right? So the building value, about 25 to 35% of that is eligible to be written off in a period of 3, 5, 7, or 15 years. Now, in 2023, 80% of that amount can be written off right away. So, example, $300,000 falls into that class, 30% of the million. You can take an immediate deduction in 2023 of 80% of that 300,000. That loss, let's make the math simple, right? That $250,000 loss that you just created in year one, if you follow the rules of short-term rentals properly, that loss will offset your W-2 income to $250,000, whatever that overall loss is. If you have 2 Airbnbs, you can go more. So you can offset W-2 income single to about 270,000, married to about 550,000, right? Pretty powerful. Now, we've seen people with high W-2 income. We've executed this strategy many times, 2021, 2022, that they have offset almost 100% of their W-2 income, right? A couple West Coast tech people. And now here's the trick. You do this, you save 100,000, 150,000 in taxes, keep the snowball going. You just recouped your down payment money, right? You just got 100% ROI. You take that cash and you go buy the next one, right? You got to keep it going, keep the strategy going, and then that's how you start scaling. Yep. So again, that one is very specific. There's a lot of rules and nuances to that, but oftentimes, I mean, we've had dozens of clients come in from other CPAs say they say you can't do that, understand that, but when you look at all of the regulations, all of the laws, it actually is the proper way to do it, right? If you follow it properly, it's the proper way to do it. So that's a newer strategy, not, in John and I's world, we hear this all the time because we're in all these chatters about it. But like in the general, grand scheme of things, not many people know about that one, and it's probably the best way for a W-2 employee to offset their income right now. That also is a pretty good investment. So
investment strategy, right? And one of the things I think we get in here, and I want to, so I think you have a lot of strategies, and I would encourage anybody to, book calls. I'll make sure there's contact information below if you want to get some calls with these guys and understand what they can do for you. But investments themselves, right? There's a new class of investment out there, some eco-friendly,
Mhm.
I know carbon cleansing, a lot of these that the government is doing some very interesting incentives to actually then provide some write-offs against W-2 and active income. What are you seeing and hearing about those?
Yeah, let me just jump in here to start, and then I'll pass it to John to go through them. As a general theme, we always tell people you can't, when the tax code changes, right? Change in 2017. There's been some updates again from the recent acts that were passed at the end of last year by the Biden administration. We always tell people don't get so caught up in the headlines of like the polarization of the good and the bad, right? Just take a step back and
Right.
know that there's opportunity. The tax code is written as incentives, right? Think about like people say, oh, why do insurance companies make so much money? Because they don't really pay taxes, right? There's all these incentives out there for certain industries, but they change over time. So generally speaking, the 90s and early 2000s, the incentives was in the old school energy, right? Oil and gas, great incentives for that. But now they're changing. Now they're changing
Right.
into green energy, so you need to follow government policy. They're trying to incentivize us to
Mm,
behave in certain manners, whether you agree upon it or not. That is where they're steering the current tax benefits, and we've just seen it double
right.
in the last year or so. But I'll let John kind of go into some of the specifics of the green energy policy.
Yeah, like Greg said, I mean, it's a the tax code's a book of incentives. So as long as you follow kind of the government's lead on those things, whether you agree with it or not, there's gonna be incentivizing items as it relates to investment. So, I mean, thinking obviously like electric vehicles, which is popular among people, solar, right? Solar on your home, your personal residence, and on investment properties. And then in terms of like getting back into real estate, right? Like whether you're, renovating properties, you're developing, you're going to do fix and flips. High, energy efficiency is rewarded on a significant basis, right? So those are kind of all things that like if you're thinking that way and there's opportunities that way, more often than not, there's going to be a tax incentive as it relates to green energy and kind of the prominence that it's becoming in a lot of these different industries.
Yeah, and like all those things John just mentioned, right? Solar, there's solar tax credits, there's solar depreciation, there are electric vehicle credits, both for personal use, right? They did actually just we're in April. They just published the final list a few weeks ago of what qualifies up to $7,500. There's also business electric vehicle credits with no income cap, meaning you can make $37 trillion and still get a nice $7,500 tax credit. Nice for business owners. And then what John was alluding to there at the end, with real estate, right? There's these two niche sections that have been around, but they just got boosted in last winter, Section 45L and 179D. They're both energy efficient upgrade sections, meaning new windows, new doors, new HVAC, new envelope renovations. If you meet Energy Star or greater for some of them, you're going to get either a large deduction or a large credit. Now, I would say that even though these are becoming a little bit more prominent, 90% of investors miss them because they're not educated about them. The thing with the tax system is the government's not going to say, "Oh, Christopher, you really should have claimed that 45L on that project you did." No, they're not going to tell you. That's not how it works. They're
Right.
like, "That's great, another guy that didn't know what he was doing." So they're not going to come and tell you this. You need to get around the right people who are going to tell you about this, and then you can start looking at a project saying, okay, well, I'm going to put 500,000 into this project, but based on this thing I learned, I'm actually going to get an immediate tax incentive refund of 25,000 because of this type of project, right? And that helps in your underwriting. So
Wow.
again, a lot of these things, it's
Yes.
our biggest struggle is making sure people get educated on it, so they can bring that
Mm.
idea to us. Hey, I'm going to do this project. Let's make sure we think about these kind of weird tax sections that are out there.
Well, and this is all great, and I know we can continue to talk about these strategies for hours, and this is what I love geeking out on too. But I think what's really important, and I really want to share with people, is that both Greg and John, you and your company believe wholeheartedly in this advanced planning, in a lot of education, and also delivering automation in the way to serve people. And because of that, you have a big announcement to make about your company today.
We do. Breaking news. Breaking news. We kind of with that, like with our vision, we kind of understand that we're different than kind of your normal professional services provider, and we always have kind of wanted the brand that meets that. So we're officially changing our name to Anomaly, which the definition of that is a deviation from what's normal, standard, or expected. And I think it's for us. It definitely characterizes us, but we also want it to characterize our clients, and we want them to be the anomaly in kind of an industry where it's reactive, and focusing on taxes and focusing on the strategies is maybe a bit devalued. I think we want our clients to be empowered to be that anomaly as well. So, and it also, like you said, Christopher, lends itself to we're trying to be on the cutting edge of technology too, and how we deliver our services, right? So that goes in the tax strategy point, right? Like Greg and I just did, and like you said, we could talk for hours about strategy. And these things are all true and they apply to a lot of people, but you have to do them and you have to execute them, right? There needs to be that follow through. And that's a lot of what we're trying to do, is be that execution partner with our clients, not just give them the strategy, but help them implement and actually do it. And a lot of our kind of technology, education, guides, and resources we're really trying to be innovative in that respect to be able to kind of walk lockstep with our clients and catch them where they're at. So those are kind of all blend into the new brand, which we're very excited about.
Well, and I think it's very exciting, and I think that it also is something, to me as a technology employee, really resonates, because they talk about the fact that all companies are becoming technology
Right.
companies, right? You need technology now. And when I think about, your firm being, remote first, and you really are technology driven, and not just that, but you're really trying to make a name for yourself in and amongst the certified tax planners, being somebody that's different. I think Anomaly fits. I like it. I'm
Love
excited
it.
about it.
Yeah, no, we're excited, and we have some big things in the work in the next year as well, and doubling down on technology and just trying to make people's lives more efficient and easier is part of our goal as well.
Well, because I think when you get into the cadence, right, when you think about, I'm no longer working with a tax preparer, right, which, and I want to bring to life that experience. What that experience was like for me is, you do the best you can. You're right. And you said it earlier, Greg, like you read the thing, oh, they're withholding taxes. You get to the end of the year and you're like, oh, crap. And there's this look, there's this feeling, there's, you know, writing that check or making that transfer that's brutal, versus when you're working with a certified tax planner, right? You're getting text messages. You're getting like, hey, did you remember to do this? Okay, great. And you're doing these little micro movements, micro management throughout the year that leads to then, to your point, ROI. I mean, this to me was fascinating, is, hey, here's going to be the certified tax planning fees, but we're going to deliver that back plus more. That to me is then a partner. You're dealing with a partner and not just a somebody who's just a commodity or a service
Absolutely, and
provider.
one of our core values is being partners in success. And you mentioned the ROI, and we always tell people, look, doesn't matter where you're at, there is probably something out there you can do, and if it saves you $500 next year, that's great, because or $1,000, right? Over 10 years, that's $10,000. Reinvest that at 7 to 10%.
Right.
That's a nice ROI, right? So we never say, like, don't be lazy and don't leave things on the table just because it requires a little bit of effort. Get a system in place. Most people, like, the government does publish these studies once in a while, like the amount of overpaid taxes. It's incredible. So figure out what applies to you, and then just start chipping away. Right? You might not overnight, achieve tax-free wealth, but you got to start somewhere,
Right.
right? So I think people can get overwhelmed, like, oh my gosh, I have such high taxes. Well, if you paid 28%, maybe you can get down to 26% next year, right? Through a couple of different strategies. So
Right.
start somewhere, and then just know that those savings compound. It's not just one time; it could work for 10 straight years. So that's what we always try to teach people too, there at the beginning of this journey.
That's right. And then I can't remember what is that you talk about. You say that you want to be, working with the tax code because you can achieve all its benefits, or you have
Yeah,
a
we
phrase or
like to
something
say
like
that
that you
that
say.
tax codes are your roadmap to wealth, right? Because it was as I kind of alluded to before, it really, although, as we said, it's a book of laws, it's also a book of incentives. So that if you follow it properly, it's going to say what you can do to not pay tax, right? Everything is taxable. Everything
Mm.
is taxable unless the tax code says it's not. So finding those different areas and opportunities is awesome. And, I think that um, people will say like, well, why doesn't the uber wealthy, why are their tax rates so low? Well, ultimately, Christopher, it's because they have invested in the right type of activities. They have structured things the right way. They have found the necessarily just live off the leverage that they've created in these massive brands and companies. So it doesn't mean that someone
Right.
at 1/10 of their net worth can't kind of do the same thing, right? There's nothing in the tax code that says you have to make $1 billion to do this. It's all there, and it's just a matter of,
Right.
can you apply it to your specific situation in life, and if not, can you follow that roadmap to get there over time?
Yeah.
Oh, that's great. All right, we have definitely gone long, but I have had a blast. This is awesome. We're going to go into the fire round where we ask 5 key questions. I don't even know who's going to answer them, but we're just going to dig
We can go
into
back
it.
and forth.
So, what soft skill has helped your career the most so far?
I'll go first. Well, I don't know that I'm good at this though. I mean, can I say what I want it to be, or is that good enough?
There you go. Yeah, yeah,
Uh,
yeah.
I
What you're
think I
focused on. We're
think
all learning,
being
right?
like listening and being patient, right? I think
Mm.
my wife has beat me over the head with that. So I think those are things that maybe are more what I strive to be like. But I think those are those are those
There you
are
go.
those are big soft skills that are needed, right? To be able to listen and evolve with the feedback that you get.
For me, for me,
That's
I'd
great.
say it's asking questions, right? So always asking
Mm.
why, of clients, of other tax
Mm.
professionals, just asking a lot of questions, not having all the answers, just asking questions to try to keep learning, and picking up little tidbits here and there.
That's great. What is the worst money advice you've ever received?
So I think what's common among the industry, and Greg will agree with me, is that like maybe this is more of a tax preparer advice is,
Yeah.
hey, why don't you go buy this car on December 31st or something like that, or you made too much money, that's why you're paying so much taxes. I think we hear that as a revolving door, and it just makes no sense to me.
Yeah, I mean, I'll double down on that. Like, I mean, it's kind of a running joke in our communities of, yeah, just, hey, go spend $100,000 on a terrible asset just to save 30,000 in taxes, right? Like, well, is that a really good investment? Probably not.
Uh,
And the second one, as John mentioned, is like, that's a very old school saying is, the multimillionaire complains to CPA and they say, oh, sorry, you just make too much money, right? It's like, no, that's not good advice. So that's just two things we commonly hear in our industry.
wow. No, that's great. That's actually great. How do you both keep learning?
Greg, you can start so I don't steal your answer this time.
Sure. So for me, I'm particularly keen on podcasts. So I'm a podcast junkie, and I listen to like literally dozens per week, probably every time I'm outside walking, commuting, what I'm doing. I'm always listening to podcasts. I do focus on obviously niche specific industry stuff, but I also listen to a lot of entrepreneurial ones as well, and just try to learn from
Mm,
people that have been there, right? And I'd probably, I pester John
that's
all the
great.
time with these things I'm hearing. It's like a new idea every 5 minutes, but there's just so much education out there through the podcast these days. Like, so in what generation did you have access to have these 1 hour listening sessions with billionaires,
Right.
right? That exists now and exists every week.
Mm,
So podcast to me has been life changing on an education standpoint.
Yeah, I mean, it's along the same lines, but I just think like, there's that like concept of like being the like listen and be like the dumbest person in the room, or you want to be the dumbest person in the room. And we speak with so many
right.
different people, even like you, Christopher, and it's just you can learn something from everybody. Everybody's doing something a different way.
Mm,
And just taking the time, I've learned so much from our clients, from mentors, from people, from people on our team, right? And just kind of going in with that mindset has been huge for me.
that's great. What do you both do to recharge?
I would say, my best kind of recharging is actually exercise, right? So trying to work out, be active, be outdoors, gym. I love to
Mm,
be active. That helps me kind of stay mentally clear and sharp. So that's the big one for me.
Yeah, I would agree with that. I mean, I think family time too for me, right? Just spending time with my family. I have two young kids, which,
Yeah.
actually it's probably not a recharge, but it recharges my soul.
That's
So
a good one.
I guess that's good.
That's right. Yeah, yeah. Not
Yeah,
my body, but
exactly.
my soul.
Which
I'm
is
with
which
you.
is more important.
That's right. And then what's the advice that you give to your younger self in your career?
I would say it's taking risks, right? So take a risk and be open to change. So, I made the
Mm,
kind of the jump to change, the entrepreneurial jump in my career at around 28 years old. And, sometimes I'm like, wow, I wish I was taking more risks earlier, but take risks when you're younger in your career, because there's always a fallback plan, right? I always had the fallback plan that
yeah,
if this doesn't work, I was doing pretty well as I was. So just be open to risk, open to change.
Yeah, I would say,
that's great. What about you?
be ready to figure it out is kind of like a saying that I would say. That you're not. I think to
Mm,
like if you're going to go out on your own or kind of like take an entrepreneurial journey, there's like so much stuff that you're just not going to be taught how to do, right? Even if you go to the best
mm,
institutions in the world, they're not going to teach you. I mean, a lot of colleges teach you how to be an employee, so which is good, which is really really good,
right.
and I think it's great. But I think that is something for me is like there's a lot of stuff you just got to figure on your own and you got to be okay making mistakes,
Mm.
and
Mhm.
learning from them. So those are some big things that I would say to my younger self.
Excellent. Well, I can't tell you guys, this was phenomenal. Had a blast. I could definitely keep going for another hour or two, having so much fun. But where do we get in touch with you? What is the new? And I'll put all this on the episode page so that people know. But how do they get in touch with Anomaly?
I love that. Well, the new website is anomalycpa.com. So that's easy enough.
Okay.
You can find Greg and myself on LinkedIn, and then Greg, in terms of the social handles, we're on all social media platforms, with at anomaly underscore CPA. So that's kind of where you can see
Oh,
us.
great. Okay, great. I'll get all that stuff loaded. Well, hey, thanks so much. I really appreciate it, fellas. And I think you added a ton of value today. So thanks so much.